All right, we're up and running. We're good to go.
Let's get it going.
Hello, everyone, and welcome to the show. My name is Chris Alaimo.
And I'm Ben Gassaway. Together, we are the Amateur Investors.
This podcast is our open source journal of everything we learn about investing and wealth management.
We're here to explore the key concepts, market dynamics, and investing strategies that will assist you on the path toward financial independence and financial literacy. Our mission is to build us up from amateurs to experts.
All suggestions are our own, and we recommend that you do your own research before taking any investment advice. See you in this week's episode. We hope you enjoy it.
Hello, everyone. Welcome back to the show for another episode. Today, we are joined by a special guest, Mr. Josh Paiva. He is the founder and CEO of Oakton Taxes and my boss as well for some part-time work I'm doing, helping Josh out with his tax business. So I just want to sort of share the wealth of knowledge that Josh has in sort of the tax code. And he's just really been an invaluable resource for my own personal tax planning and just building a knowledge base around taxes, which is just something a lot of folks don't really have a full appreciation of. So Josh, I just want to extend the floor and just thank you so much for being on the show today.
Yeah, well, thank you so much for having me. I've been really looking forward to it.
Yeah, absolutely. So Josh, I know that your resume goes a little bit beyond just Oakton Taxes. So maybe give the audience some context around your professional experiences beyond Oakton. I know it's not a short list, but would love to hear some highlights about what you've been involved with in the past and what you're still doing now.
Sure. So really early on in my career, I was an EMS supervisor and then an Army officer, which was a lot of fun, but it led to my work as a management consultant, specifically in the fields of healthcare, emergency management, that type of thing. After a while, I took all the typical accounting coursework at UVA. And about 6 years or so of being a management consultant, after about 6 years or so doing that, I found myself more and more working on things like cost accounting, payroll, taxes, planning, budgeting, forecasting, things like that, both for our clients and on the in-house corporate side of things as well. So eventually it became pretty obvious that I'd sort of become everyone's go-to person for not only things related to corporate finance and accounting, but also personal financial management, things like that. I really enjoyed all of that. So about 6 years ago now, I took the next step and founded Oakton Tax and Accounting, which has sort of grown exponentially since then.
That's awesome. And it's really impressive. I feel like just taking what you've learned from the professional setting and just making sort of your own asset for yourself. Was it easy to maybe get the first few clients? I imagine that you're just the go-to guy. You're still the go-to guy for a lot of things.
Yeah, I guess so. No, it was honestly pretty simple because a lot of people were already, it started out, of course, with friends, coworkers, clients, family, that type of thing. But it grew much faster than I expected. That's for sure.
That's awesome.
That's good. All right, Josh. Well, I guess we'll dive into taxes. I know most people, hate talking about it. Ben and I surprisingly enjoy this topic or just investing topics in general. So I know most people love getting big refund checks at the end of the year. I guess, is that kind of the goal of, doing your taxes and stuff like that? Or is that a common misconception among normal folks?
Yeah, so that's a really good question. I don't know about you, but I prefer getting money rather than owing it, right? That's always better. But that's not really how taxes work. If you ignore taxes and just think about the word refund for a minute, a refund means you're getting money back to you that you had already paid. It was already your money to begin with. Tax refunds are no different, same thing. A big tax refund just means you had too much money taken out of your paycheck, too much tax taken out of your paycheck. So all year long, you're getting these smaller paychecks than you should have been getting, and you gave the government a big interest-free loan that you're just now getting back as your refund. But you could have had that money way earlier. So either you have a big refund or you owe a significant amount of taxes, but then you really should fill out a new W-4 if that happens, give it to your employer's payroll team. So that refund or the amount owed is as close to zero as possible.
Mm-hmm.
It's your money. You want to have the right amount on every paycheck year round. You don't want to have to wait until tax time each year to get your prior year's earnings back to you.
Yeah.
Sorry, Chris, even talking to like friends and family, people are always banking on that big refund. Even me, I always kind of fall victim to looking for that fat check. But when you think about it, something that Chris and I advocate for on the show is paying yourself first. You can't invest in sort of your retirement plan or your other investment platforms if the government is holding your money. So that's just a common misconception. And I feel like I'm trying to unlearn that poor habit towards the government.
Yeah, I know me personally, on my second stimulus check, I know that's kind of, they're pulling forward your taxes from, I think, 2022. Like, correct me if I'm wrong there. But basically, I never got one. I'm like, can I charge them interest on a loan that they never gave me, basically? So exactly like you said, it's kind of like lost capital or sunk cost of, you gave them a free interest-free loan. I wish I could charge the federal government interest on, taxes that they took out that they weren't owed, really.
Yeah, absolutely. And actually, if you file your taxes late, if you pay them late, you definitely have to pay interest and fees and penalties and all sorts of bad stuff. And also, if you file your tax return on time and you're owed a refund, if the government's late, so it takes them past April 15th to get that refund to you, they do pay you some interest, although it's not very much. It's like
Nominal
a percentage
savings
point or two
account.
right now.
Yeah,
Yeah, exactly.
What was the rate?
It's pretty low right now, same as most banks. I believe it's somewhere in the 1% to 2% range, but it's not very significant at the moment.
Not great.
No. All right. So I guess, is there any tips that you have for keeping that closer to zero? I know you kind of mentioned if they're taking out too much from your paycheck from your employer, you can resubmit a W-4 form. Is that correct? Or W-2, W-4 form?
Yeah, exactly. So W-4 basically tells your employer how much tax you want them to take out from your paycheck.
Mm-hmm.
So if you only have one job and your household has no other income that's taxable, no other kids, then all you need to do is just check your marital status, so single or married, and you can leave everything else blank and you'll be fine. On the other hand, if you have more taxable income than just that one job, then it gets a little bit more complicated. The new W-4 forms actually tell you to go to irs.gov/W4 app. So it's irs.gov/W4 app. And that's good advice. It will ask you some questions. You'll need to have your previous year's tax return, so your Form 1040, and all of your most recent pay stubs. But it'll ask you a couple questions and it'll tell you exactly what to put on that W-4 to make sure you don't owe money, but you don't get a big refund either.
Yeah, are there any like good calculators out there to kind of like test what it would look like at the end of tax season? Any resources that you look at to kind of simulate taxes? Anything out there?
So there's not really any great ones that I've found. I think one good option is use whatever you did to do your previous year's taxes and just make a copy, essentially. Do a fake version, do it over again, pretending it's a year later. Of course, tax rates change a little bit from year to year, but it's going to be roughly the same. And you can just put in, okay, what if the government, or what if my payroll provider had instead taken out this much? Then what would my refund be? Another way is just look at your W-2. On your W-2 from last year, it'll show you in box 2 exactly how much your employer took out for federal income taxes, and compare that to how much is coming out of your payroll now. And if they're taking out less, then of course your refund's going to be equally less. If they're taking out more, it's going to be larger.
Got it. No, that's really good advice. I think a lot of folks maybe have sort of a blind side to the W-4 and maybe the exceptions and sort of like what you're claiming. So I'd love to talk through maybe some of like the tax planning strategy, like in a timeline perspective, maybe starting with like a college or high school grad. I think a lot of our viewership is on the younger side. So let's say you got your first job and you want to plan ahead for the future, starting things right on the side of taxes. What are some of the important accounts to invest in? I know we covered sort of like how to set some of the information on the W-4, but what are some important things to be aware of early on in a career to mitigate the tax impacts that some folks just carry on throughout their whole career?
Sure. So first and foremost, take advantage of whatever pre-tax benefits your employer offers. So your employer's retirement plan, especially if that offers any matching contributions, make sure you're contributing whatever's required to get that full maximum match from your employer. It's free money. If you don't do that match, you're just leaving it on the table. If your employer allows Roth contributions, so Roth sort of means post-tax, whereas a traditional 401k is pre-tax. But if your employer does any Roth contributions, early in your career, that's probably the right thing to do. You're probably better off doing Roth. The reason for that is Roth basically means you get no tax deduction now, but that money will grow tax-free. You can withdraw it in retirement tax-free. It's essentially tax-free forever. That's a great deal if you're in a really low tax bracket today and you expect to be in a much higher tax bracket when you retire. And that really should be everyone's goal when you're just starting off. So yeah, so just to recap, I would definitely take advantage of those employer plans, get that full match, and early on in your career, definitely take advantage of that Roth option specifically.
Yeah, on that point of sort of the Roth versus traditional 401k or IRA, traditional IRA versus the Roth IRA, I sort of have an ideological debate when I'm talking to folks where they're running through the situation and say, let's say someone's in their career 50 plus, maybe they're like at a high level in the corporation. Is there a point when you switch to traditional? Is there sort of like an inflection point where the cost benefit analysis of being post-tax versus pre-tax changes situational? Personally, I like the idea of letting my gains grow and compound totally uninhibited by the friction of tax, whether it's mathematically sound or not. If let's say there's $1 million in my account of retirement, I want to keep that. I think there's a sort of a mental thing to that, but I'd love to know like what your mental framework is on that of when you go from a Roth back to traditional, if you do it all.
Sure. So I think as you go further along in your career, you need to look at two things. What tax bracket are you in right now today? So including state. So what's your federal marginal tax bracket? What's your state tax bracket? Add those two together. What's that number? And compare that to what tax bracket do you think you're going to be in during retirement? Again, including state. So that can be kind of hard to guess. But take a look at how much do you think you're going to have saved for retirement? How much do you think so if that's all in a taxable account, like a traditional IRA or a brokerage account, then okay, how much do you plan on taking out every year? Because that's all taxable income. And do you think taxes are going to go up in the future? Hint, yes, they will. So basically it's comparing those two numbers. What tax rate are you in right now today? And based on what you think your income is going to be in retirement, what tax rate do you think you're going to be in once you've retired? And whichever one of those is lower, that's the one you want to pay. So if you think you're in a much lower tax bracket right now today, because you're early on in your career, you don't have you maybe are saving a lot for retirement, then by all means do Roth. Pay the tax now and let it grow tax-free, take it out tax-free, do Roth. On the flip side, if you're looking down the road and you think, you know what, I'm making a lot of money right now, I'm in a pretty high tax rate, I don't think I'm going to stay in this high of a tax rate. I think when I retire, my income's going to be a lot lower. Then traditional might make a lot more sense than Roth at that point.
Got it. No, that was really great advice.
Yeah.
Sure.
So I guess this is kind of four-parter or four-pronged for me. So I guess how would you advise someone that's, a few decades into their career versus someone that's just kind of, preparing to prep for a family, one that's prepping for retirement, and then maybe even one that wants to try and retire early. So kind of four categories. One that's mid-career, 40s, 50s, one that's probably closer to 65, someone that's younger, that like Ben and I, but maybe a little bit older and married and looking to start a family. And then one that's looking to retire early. You're worked from 22 and now you're looking to retire by early mid 30s to late 40s or to early 40s.
Gotcha. I might need to take some notes, Chris. That was a
Yeah,
lot. You
sorry,
might need to cue me a little bit there.
We can go
Let's start with a few decades into the career.
A few decades, yeah.
So sure. So mid-career, it's kind of going to be exactly the same as I was just saying a second ago. It's how much do you have saved for retirement? Do you think that you've got so much saved for retirement that your income's going to be higher in retirement? Then by all means do Roth, excuse me. On the other hand, if you think, you're still a couple decades mid-career, but you don't have that much saved for retirement, and you think your retirement income is going to be significantly lower than what you're making today, then traditional, definitely traditional. What was the next one?
The next one was, prepping to start a family. So I guess this is more savings and, planning for retirement, but while also saving for a family, basically.
Like for college, like thinking about like those goal-oriented savings where it's like, I've got my retirement nest egg, I'm building that up, but now I got to think about this child's future. What are some things that folks maybe miss or, should start as soon as possible?
Yeah. So for college savings in particular, most states that have a state income tax offer some pretty great benefits for doing the state-sponsored 529 plan. Some states allow you to use a private broker or private investment advisor for that, but many don't. So you're generally going to want to go to your state-sponsored 529 plan. And that's a great place where you can save for college tax-free, withdraw it for college expenses tax-free, and also immediately get, in most states, a tax break on your state taxes as you put money into that 529 to save for college. And you can still invest that money based on, let's say, you're 10 years away from sending a kid to college, then you can be a little more aggressive than, let's say you have a 16-year-old and you got to send them to college in 2 years. So there are definitely some options there, but there are lots of great investments that are in those state-sponsored 529 plans that are a really good thing to check out. Of course, before you start investing, I think what everyone needs to do is make sure they've paid off any high interest debt first. So if you've got substantial credit card debt, things like that, that really needs to be the first thing to go away. Get rid of that high interest debt, then start looking at saving for that retirement. Now, ideally, everyone should be saving 15% for retirement from day one, from the second you start your career. That's not always possible. Life gets in the way, but really you want to try to start doing that from day one if you can. Save at least 15% for retirement after you've paid off all that high interest debt. And then you can start looking at things like 529 plans for college savings and eventually those taxable brokerage accounts where you can really have some fun.
Yeah. I know for me, I know my dad always used to take out like 10% of my salary and just be like, he threw it in a savings account just to represent like saving for retirement. He wasn't investing it or whatever. I guess in hindsight, I wish he was. But then, you get older and you realize there's these things called taxes. There's things called living expenses. There's things called like bills that come up that you weren't expecting. So, I guess that I kind of got the abbreviated version of life or the less harsh version of life growing up from my allowance from my dad. So I guess
it's a good, I mean, that 15% number is a good target. You know what I mean?
Yeah.
Like if you're a little above, a little below, but you're aiming for something, I feel like having a target is always key because like you said, life comes up, but it's good to have sort of a North Star of what you're trying to do.
Yeah, and that 15% number is great if you start it young, when you're in your early 20s. If you don't start saving for retirement until you're in your 30s, then 15% is going to be nowhere near enough. At that point, you're kind of a little bit behind the 8 ball, and it probably needs to be 20% plus. That 15% really ideally only works if you start in your 20s when you're young. The other thing I would add, and I think you touched on this a little bit, I thought it was a good point. I hate the term saving for retirement. That's a terrible way to describe it, because if you just put money in a savings account, you're going to lose because inflation is going to grow faster than your savings will. I think really a better way to think of it, to conceptualize it, is you're investing for retirement. Saving for retirement doesn't work. You have to invest for retirement.
Yeah. And I know even there was I Will Teach You to Be Rich. I know that's by Ramit Sethi. He said one of his friends, when they were 23 years old, she started putting money into a Roth IRA account, but she was just putting it into the account. She didn't actually pick investments.
Oh, gosh.
So just sitting in cash.
That's horrible.
Yeah, so she was like 32 or 33, so 10 years had gone by. She's like, yeah, like it's going up because I'm putting money in it. He's like, wait, but what did you invest in? And she was like, what do you mean, what did I invest in? I put it in the account. He's like, oh no, like she didn't pick anything. So she basically had what was even worse than a savings account because it was just, not growing. It's just basically a glorified checking account, or I guess, a tax advantage checking account.
Right.
I guess being behind the 8 ball, but that's a lesson that you'd rather learn much, much earlier than when she did. So I guess, is there any advice for someone that wants to retire early? So I know a lot of people, the FIRE community, not saying that I hope to be like that one day, but the people that want to do, what is it? Financially, I forget the acronym for it.
Financial independence, retire early.
Yeah, that's what it is. Yeah.
So I think for that, 15% is obviously nowhere near enough if you want to do that. Depending on how early you want to retire, you need to be looking at 25 to 50% of your income that you're investing if you seriously want to do that, which is not possible for everyone. And I think those of us who can do that are pretty fortunate to be in that situation. But at that point, if you need to save 25 to 50% of your income to retire early, that means you're being really judicious on what you're spending money on, cutting down your expenses. And of course, you're going to max out your 401k and probably not be anywhere near that 25 to 50% mark. So you're going to need to start looking at other types of tax advantage savings accounts like IRAs, traditional IRAs, Roth IRAs, If you're self-employed, you get a whole bunch of more options too, like different types of solo 401ks. Some solo 401ks, if you're self-employed, you can even do up to about $57,000 a year if you set it up correctly. All of those things can get a little tricky, and it really depends what your taxes look like, what your sources of income are, how much income do you have any existing IRAs? So it's a good thing to discuss with your CPA before you attempt it, just because if your income is too high, for example, and you're not eligible to contribute to a Roth IRA, but you do it anyway, there are some penalties for that if you don't correct it on time each year. So there are lots of things you can do, but you just probably want to consult with someone before you do it to make sure you're, based on your income and what you're eligible to do, you're picking the right accounts. But there are definitely lots of other options out there.
Yeah. If sorry, Chris, if retiring early is the goal, is investing in those tax advantage retirement accounts really the place to do that, just because you're locked up at 59.5? Like, do you still recommend that, or do you overweight taxable?
No, so taxable should always be last. Start with maxing out your employer plans, then max out whatever types of IRAs you're eligible for. If you make too much for a Roth IRA and you don't have any money in a traditional IRA already, then what you can do is put the money in the traditional IRA and then immediately convert it to a Roth, which is called a backdoor Roth conversion. That gets really tricky again, because you just want to be careful doing that, because you need to make sure you put it in the right type of account, you convert it correctly, and that you don't have any other money sitting in IRAs, because otherwise you'll end up with a big tax bill. But anyway, you start out with those employer plans like 401ks. Once those are maxed out, you max out your IRA or your backdoor IRA. And then you start looking at those taxable brokerage accounts. And likely, if you're trying to retire early, you'll need to do all three. There's no other combination is going to get you to save enough money to really retire early if you're not doing all three of those.
Yeah. So kind of expanding on Ben's point, that's exactly what I wanted to ask. But I guess, have you worked with people that have retired early, and how do they bridge the gap for, let's just say they're 40? How do they bridge the gap from 40 to 59.5? That seems like, such a condensed amount of time. You're saying you're starting in the working world at 22 to 40. Then you have to last 19.5 years to get to 59.5 to really touch the nest egg of what you've been lumping away over your whole career.
So that's a really common misconception. You actually can touch that money really any time. There are of course, some rules, and you need to be careful about how you do it to avoid paying taxes and penalties. But let's take your Roth IRA, for example, which hopefully if you're doing this, you'll max that out for many years and you'll have a pretty sizable balance in your Roth IRA. Now keep in mind, again, there are income limitations for that. So you may need to do what's called a backdoor Roth. So be careful when you're doing this. But anyway, when it's all said and done, you're going to end up with a lot of money in a Roth 401k or a Roth IRA. You can touch that money anytime, the basis in it, whatever you put in before earnings, you can take that out at any time, tax-free, penalty-free, any age, anytime, any reason, as long as you're only taking out the basis, what you originally put in that Roth account. So that can tide you over for a good chunk of that time. Beyond that, there are other ways you can take out money early from 401ks, from IRAs, from traditional accounts. For example, for medical expenses, for all sorts of, in some cases, for the first purchase of a home, or for educational expenses. And there are a lot of rules on all of those things. It's not quite that simple, but there are lots of ways you can take that money out early. Also, later on, as you get to the point where you've taken advantage of all of that, you've taken advantage of whatever other sources of income you have, and you still need more money out of it early, as long as you do substantially equal periodic payments. So essentially you retire, you start taking out a fixed amount every year. And again, there's all sorts of rules and math and calculations you have to follow to do this. But once you start those qualified, substantially equal periodic payments, those again don't have a minimum age. You can do that at any time, as long as you do it, well, just like it sounds, as long as they're substantial, they're equal, and they're periodic.
Mm-hmm.
That's awesome. Honestly, those insights I think are really helpful, because even I was a little bit confused about what sort of flexibilities are afforded with the retirement accounts. When I think about it, I just think it's absolutely taboo to want to take anything out. But if you can take from the principal, and the goal is to retire early, I don't know if necessarily that's something I'm targeting per se. The goal hopefully is, we create our own business or something of that matter, and it's a cash flow positive asset that we don't look at. It's totally past. That's the goal. But if you need to touch that, knowing that you can touch the principal is good.
Yeah, and I think you raise a good point. I would pretty much never recommend taking money out of retirement accounts early. Just because you can doesn't mean it's a good idea.
Yeah.
I think that's not something you should do unless you've got, a couple $1 million saved and you have a plan on how you're going to spend that in retirement and you're following that plan, it's much better to take that money from other sources before you even think about touching retirement accounts. In some cases, you may even be better off taking a very low interest personal loan or car loan or home equity loan before you even think about touching a retirement account. It really just depends on your circumstances and what you need the money for.
Agreed. Yeah, I feel like a cash generating asset, like a real estate, a rental property, a business of sorts, that would definitely be prioritized on over tapping into the retirement account. I feel like that's just not the vehicle. Like if that's what you have to do, then maybe retiring early isn't the best thing for you. That's my 2 cents.
Absolutely, yes.
So switching gears a bit, focusing on taxes specifically from the eyes of an investor, I'd love to maybe dive a little bit deeply into capital gains tax, which I don't think, Chris and I, we always kind of come up with this coin term that taxes and inflation are silent thieves. So I'd love to know what, from your perspective, are some of the common mistakes that you see from clients in maybe their trading or investing habits, and any tricks or tips to really move the needle on mitigating taxes at the end of the year. I feel like that's a really key thing to master.
Yeah. So first off, capital gains taxes don't apply to qualified retirement accounts. So if you're taking those things first, so your 401ks, your IRAs, if you're maxing all of that out first, then you really don't need to worry about capital gains tax because they don't apply. We're really just talking about taxable brokerage accounts, which come after you're already maxing out all of those tax advantaged accounts. So 2 really important things. Number 1, if you hold those investments in that taxable brokerage account for at least 1 full year before selling, you benefit from a much lower long-term capital gains tax rate. You'll pay significantly more in taxes if you're constantly selling things that you haven't held for a full year. So make sure you're being smart when you're picking investments and you're really thinking long-term and you're holding on to things for at least a year, because you will pay lower tax rates that way. Number 2, try to avoid what the IRS calls wash sales. A wash sale is when an investor sells or trades or otherwise disposes of something at a loss. So whatever it is, you bought it at this price and now it's down here, you sold it at a loss. And then within 30 days or so before or after that, so either 30 days before or 30 days after that sale at a loss, that same investor or their spouse or a legal entity they control, IRS treats them all the same, but that same investor buys another one that's substantially similar. So for example, if I sell Berkshire Class A at a loss because I want to take a tax deduction for that loss, but now my wife buys Berkshire Class B 2 weeks later, I can't deduct that loss on my taxes. That loss would instead just be added to her cost basis for Berkshire B. Most people end up never claiming that loss when these wash sales happen because the record keeping gets really challenging and they just end up paying way too much in tax because of that wash sale rule. So just make sure you're not selling. If you do sell something at a loss, just make sure you don't buy the same thing or a substantially similar thing 30 days before or 30 days after that sale at a loss. I hope that makes sense. I know those are complicated.
Yeah. So I guess because I get what classifies as a wash sale. Like I get that, but I guess what are sort of the penalties or the implications of, enacting a wash sale? Like what happens if you do that? Is it just, it increases your taxable amount? I don't think I fully get what a wash sale is.
Sure. So normally when you sell stock at a gain, you pay tax on the profit. Whatever the gain is, you pay capital gains tax on that. Similarly, normally when it's not a wash sale, when you sell something at a loss, you deduct that. So if I gained $100 selling Apple and then I lost $50 selling Google, I only pay tax on 50 because my profit was only 50. I get to subtract all those losses from my investments. If you have a wash sale, you can't subtract that loss. That loss just gets pushed forward into whatever you purchase next. So let's say I made $1,000 in stock 1, but then I had a loss of $1,000 in stock 2. I shouldn't have to pay any tax. But if I have a wash sale, that stock 2 loss doesn't count. Now I have to pay tax on $1,000 worth of gains, even though I didn't actually gain anything because I gained 1,000 and I lost 1,000. So I had a net zero, but I'm going to pay tax on that $1,000 gain, even though I didn't really have a gain because I had a wash sale.
Wow. I mean, that's something really to be cautious of. And you mentioned Apple and Google. So let's take the Berkshire Hathaway model.
Was that a mistake?
Let's say I, bought Berkshire Hathaway, sold it at a loss, and then bought Markel, which they call is the baby Berkshire, which is like they have like an insurance model, sort of investment, sort of like value investing thesis, very similar to Warren Buffett. If I bought that in the 30-day window, is that a wash sale just because the businesses are so similar? Is that something to look out for?
Nope. No, that's totally allowed. And what you can also do is, for example, Vanguard has an S&P 500 mutual fund. So does iShares. So does everyone. Everyone has an S&P 500 ETF or an S&P 500 mutual fund. If you sell one and buy another from a different company, that's actually allowed. That's not a wash sale. So I could sell the S&P 500 from my Vanguard ETF and immediately buy it in a Fidelity account or whatever, as long as it's not the Vanguard one. And that's actually allowed. That's not a wash sale. Now, on the other hand, if you buy the exact same company or a different class of common stock at the same company, so Berkshire Class A versus Berkshire Class B, that is a wash sale. That would count.
Got it. And I feel like that makes sense. I was worried that you have to be like really cautious of sectors where, because you said A versus B, I was like, okay, that makes sense. But if it's going from a Google to an Apple, I'm like, we're screwed. No trade here.
Yeah, that would be really complicated.
Yeah, so I guess just clarifying on that one point. So what are they define as like to like? Exactly like Ben was saying. You know, Berkshire A and B, yeah, basically the same company. But is it by tech? Is it by sector? So Apple and Google are both tech, so that's why, or
no?
How does it's not? Okay,
it's in company class, I guess, right?
Okay.
Yeah. So, and the rules are super complicated and lengthy, but the quick version for most people, for 99% of people out there, as long as it is a different company, you're fine. You just can't buy a different type or a different class of stock of the exact same company. But as long as it's a different company, that's generally completely fine.
Okay.
The other important thing to keep in mind is all of those wash sale rules are applied across all of your accounts. So it doesn't matter if you've got some money at Vanguard and some money at Fidelity and some money at E-Trade. Mm-hmm. All that matters is what are you actually invested in. So if you sell, let's go back to Google. You sell Google in this account, but then you buy it again in a different account. That's still a wash sale because it's still Google. You still bought the same thing.
That makes sense.
So it doesn't matter. You can't try to, I'll do it in a different brokerage account. That doesn't count. It's all your accounts combined as far as the IRS is concerned. They don't care where it's actually at.
Okay. Got it.
All right, so we're getting ready to wrap up soon. Thank you, Josh, so much for coming on. We're going to ask our last few questions here. But I guess since you started Oakton, what's your favorite thing or most interesting fact you found out about taxes, or just maybe across your career? What's the most interesting thing you found out about taxes, whether it's a tip, a trick, or something that you like or think is interesting?
Sure. Let me think about that for a sec. I think really just everything's changing. Everything is always changing. Tax laws change, regulations change, how much money you make each year changes. Just because someone's making really good money today doesn't mean that they will be in 3, 5, 10 years. Just everything is constantly shifting. And I think it's really, really important to always make sure you're saving that 15% or more in those diversified long-term retirement investments every single year. Treat it like a tax. It's not optional. It's not optional if you want to have a secure retirement. Play with the rest, but that first 15%, you really need to invest because you just don't know what's going to happen next year. Tax laws could change, regulations can change, your income could change. So I would just really don't delay, don't wait. Make sure you're investing from really early on and from day one, really. Don't delay investing. It's really important to make sure you're doing it from as soon as you start having income.
Okay. No, I love that. I think that's a perfect advice. I feel like not delaying investing could be on a t-shirt, so we'll put that in the clothing line. So Josh,
I wouldn't recommend wearing that shirt in public, Ben.
We're nerds, it's fine. So before we start our sort of standing wrap-up questions, Chris and I usually will take a question from the audience. Normally it's Chris and I answering this, but I thought given sort of the relevancy of this question, I thought it'd be prudent to ask you. So this message came from our friend Sal, and she has a 401k from her former employer, and she wants to roll over her nest egg into a Roth IRA or traditional IRA, depending on the situation, but we're going to target Roth. Any tips on sort of the best next steps to take to do this and maybe some tax implications to be aware of?
Sure. So first and foremost, Sal should consult her tax advisor or her tax attorney or a fiduciary investment advisor. I have to say that. Her employer probably offers free access to a fiduciary investment advisor. That's a really good resource that a lot of employers offer with their 401k plans. If she picks her own, make sure in writing that they're held to that fiduciary standard. That's really key. the first thing that advisor is probably going to warn them about is if you get sued or if you owe someone money, in most states, your money is protected from creditors if it's in a 401k or an employer plan. It may not be if it's in an IRA, depending on how much money, what state it's in, that type of thing. So potentially it might be a good idea, especially if you're worried about creditors for whatever reason, to keep that money in either your old 401k or your new employer's 401k. But there are some protections you get in a 401k that you do not get in an IRA. Second, always do direct rollovers. So a direct rollover means your old 401k's custodian, so the bank, but technically it's the custodian, sends those funds directly to the new IRA's custodian. Those funds should never go to you personally. The check should never have your name on it. It should never, you don't want to be the middleman there. It should go from that old account directly to the new account. Third is make sure you're moving it into an appropriate investment and not just letting it sit idle, kind of like you were talking about before. If it just sits in cash, that's not good. And finally, on the tax side of things, a direct rollover. So a direct rollover from a traditional 401k to a traditional IRA has no tax consequences. Same thing for a direct rollover from a Roth 401k to a Roth IRA. There's no tax consequences there. However, if you move money from a traditional 401k to a Roth 401k, or excuse me, from a traditional 401k to a Roth IRA, that can come with a really big tax bill. So whenever you move money from traditional to Roth, you're essentially recognizing all of that income. So you're going to pay tax on that full conversion in whatever year you do the conversion. That's not necessarily a bad thing. If you do that in a year where you, let's say, didn't work the whole year, had lower income that year, that might be a really good idea because you might be in a lower tax rate that year. But you need to be prepared for it. You want to make sure you're expecting that tax bill and you're ready to pay that tax bill, and you did it in a year where your income's low enough where it's at a good rate and you're getting a good deal, essentially. You don't want to just be surprised when you get this giant tax bill at the end of the year because you converted all this money from traditional to Roth and didn't realize you're going to owe taxes on it.
Mm-hmm. So when you do get taxed on that rollover, is that your federal income tax or is it federal, state, the whole kit and caboodle? In
most states, it will be federal and state. They'll both tax it just as if that was wages. So it's no different than if you convert $10,000 from a traditional 401k to a Roth IRA, that's no different than you getting a $10,000 bonus at the end of the year from your boss. You're still going to pay income tax on all of it, which again might be a good thing, especially if you do it in a year where you weren't working or you're in a lower tax bracket, something like that. It might be a really good idea. Another time way later in your career where that's usually a really good idea is after you've retired, but before you start collecting Social Security. If you've got a gap of a few years between you've already retired, but you haven't collected Social Security yet, those couple years might be your last chance where you're in a relatively lower tax bracket, your income's temporarily lower. That could be your last chance to do those Roth conversions, to convert that money from traditional into Roth. And that might be a really good idea. Or for those people who are closer to our age, let's say, you know what, you're finishing up at one employer and you want to take 6 months off and travel the world. So you've got a year where your income's lower, you're in a lower tax rate, you're taking a sabbatical. Again, that might be a really good year to do that. Just make sure you're expecting that tax bill at the end of the year.
Yeah, good advice.
Yeah, so just one quick thing there. So on that tax bill, is that normally, can you pay the taxes out of the account itself, or do you have to come up with it cash from whatever you've been basically making from your job or whatever income sources you have?
You'll want to come up with that from cash, from somewhere else, because if you take it out of the amount you're converting, now you're not really rolling over at all. So let's say I take out $10,000 and I keep $2,000 to pay taxes and I only move $8,000 into the new account. Now I'm going to owe even more taxes because I just technically had a $2,000 early withdrawal. I only rolled over 8 out of 10. I took out 2 out of 10. So now I have a $2,000 early withdrawal. I'm going to owe income tax on that withdrawal plus a 10% penalty for taking it out early. Okay. So you'll need to come up with that money from somewhere else.
Okay,
that makes sense. So I guess I have 2 quick questions because I find this kind of fascinating because it's a situation that a lot of folks could get into where it's like you either are rolling it over into an individual account or your new employer. It just depends. But so with the rollover from a 401k to an IRA, there's no cap on the amount that's rolled over, right? Like that $6,000, that's just thrown out the window. It just rolls over into a different account, correct?
Exactly. Yep. As long as you're doing direct rollovers, you can roll over the full amount. from traditional to traditional, from Roth to Roth. You can do all of it. Well,
And does it usually,
you can do all of it for traditional to Roth too, but that'll probably push you into a really high tax bracket. So that's probably not a good idea.
so does it usually make sense if you have a traditional 401k to roll it over into a traditional IRA at that point and then just do Roth going forward? Is that what you'd recommend? I mean, I know the disclaimer, like contact your tax professional and what have you, but I guess what would you do? That's what I would do personally.
Yeah,
I'll put my head in the stake for that.
So if I'm not worried about creditors, because again, if you have any reason to think someone's going to sue you or you owe someone money, then keep it in a 401k. Doesn't matter if it's the old 401k or the new one, but keep it in a 401k. But if you're not worried about that and you just want to manage it yourself in an IRA, not through your employer. I'm sorry, Ben, I totally lost my train of thought. What was your question?
It was basically just like, does it make sense to go from the traditional 401k to a Roth IRA, knowing you're going to get that big tax bill?
Yeah, so it absolutely can. I think the safer choice is to move it from the traditional IRA to the traditional 401k, move it from the Roth, or excuse me, I said that completely backwards. Move it from the traditional 401k to the traditional IRA.
Yep,
and then move the money you have in your Roth 401k to your Roth IRA. That's fine. Do all of that. And now wait till December. And in December, when you know, okay, this was my taxable income for the year, this is what tax bracket I'm in, that's the time you can start thinking about, okay, do I want to do a conversion? Do I want to convert this money from traditional to Roth? Because if you do that at the end of the year, when you have a pretty good idea of what tax bracket you're going to be in, you can make a much better, more informed decision at that point.
Yeah.
That's perfect. Yeah.
All right. I got one more thing before we hit the final wrap-up questions. Thank you once again, Josh, for coming on. So I guess my question's more on I guess this is more conditional, I guess, but I know most cases when your employer does an employer match, I was looking into this. Normally, even though you're putting into a Roth and they're matching it, they don't match Roth. They normally put it in a traditional. So there's normally, I guess, 3 buckets basically. There's your company match, which would be in traditional, even though it's in your Roth 401k. Then it's your principal, and then it's your gains. So it's kind of like the 3 different buckets, basically the best way to do it. So when you're doing this conversion from a Roth 401k from your employer into a Roth IRA, I'm guessing when that company traditional match goes over, that's a taxable event, or that's what's going to be taxed. You won't get taxed on the gains or what you initially put in.
They'll actually be 2 totally separate transactions.
Okay.
You're going to have a direct rollover from your Roth to the new Roth, and then those employer portion. Yep, everything. Your whole Roth to the new Roth. That's all going to move over in one check, one transaction, one taxable event, although there'd be no tax. And then there's going to be a completely separate check, a completely separate rollover for the traditional portion, which includes that employer portion. So those are going to be 2 separate checks going to 2 separate accounts.
Okay. And
that's a big thing. No, that's a big thing to highlight. Is it, Chris? I know you were talking about bucketing the gains versus principal. When you're doing this whole transaction, everything is being taxed. It doesn't matter, right? Like, so if you're going from a traditional 401k to a Roth IRA, that full amount is taxable income, regardless of your principal versus gains, correct? Okay, so that's everything.
Yep, exactly.
Brutal.
Okay. All right, I think, Ben, you want to do the wrap-ups there, or you got anything else to add?
No, Josh, I mean, first of all, thank you so much for, one, coming on the show. I think you can tell by the number of questions that we have that taxes can be fun, and I think we had a blast here today talking about them, so thanks for coming on. So the one question I always ask our audience, or our guests rather, is what has been your biggest investment mistake, if you're comfortable sharing it?
Sure. So not investing in Bitcoin when it was like brand new. I remember when Bitcoin broke $100. I thought when Bitcoin broke $100, it was insane. It was nuts to me that people were willing to pay $100 for something that is literally intrinsically worthless, not to mention really bad for the environment. Yet here we are. I think Bitcoin passed $64,000 today, although it's since dropped. But I remember thinking I missed the train at 100, and I was like, oh, I wish I had done this a couple years ago. And Bitcoin at 64,000 just still blows my mind.
when looking at Bitcoin Twitter of people like, oh man, I had Bitcoin at $1 and I sold it at $8. I made so many gains, and people like, no, like why?
No.
Like why did you do that?
The train is still chugging along.
I wasn't
That's
going to ask
crazy.
about Bitcoin, but I'm so glad you brought it up, Josh. My question's unrelated to Bitcoin, but nonetheless, I'm glad you brought it up. It makes it into every episode now. I guess what's your favorite book, podcast, YouTube channel, website, or blog, whatever it may be, about investing or taxes or whatever, basically on the topic?
Oh, well, I have to admit the only investment podcast that I have listened to is The Amateur Investor, of course.
All right.
I heard
That's
they had
an
a
honor.
great tax guy come on the show recently. I'm looking forward. I can't wait to hear that episode.
That's
All right.
awesome.
I appreciate that.
A couple other good ones I would throw out there. Planet Money has some really great content.
Okay.
I think they're always fun to listen to also.
Okay.
Cool. Thanks, Josh. So once again, thank you for coming on the show. If someone wants to learn a little bit more about your business or about you, where should they go to learn more, or even become a client if you're interested in taking new clients?
Sure. So thank you for having me on the show, Ben. I really appreciate it. It's been a lot of fun, but you can visit our website. It's oaktontaxes.com. That's OAKTONTAXES, oaktontaxes.com. And we can definitely connect there and love to chat with you more.
Awesome. Thank you, Josh. We'll be sure to include the link to your site in our show notes and our newsletter as well. So Josh, this has been a blast. So thank you so much for coming on the show.
Thank you, Josh. As
Sure.
always, everyone.
Thanks for having me.
Thanks for coming on. As always, everyone, smash the like button on YouTube, rating a review, our website, LinkedIn, Twitter, Instagram, TikTok. That's pretty much it. Thanks, guys, for watching. Catch you next week.
See you next week. Thanks, guys.